$10,000 is still a realistic estimate. I said some time ago it was five. It got to five. It got smashed down a little bit. It's kind of working its way back to 5,000 in stages. But yeah, it'll go along with with the kind of inflation that we talked about, and the things we talked about earlier in the segment, Michelle. Central bank demand is not going away. Supply is flat. Central bank demand is going up.
Let's just say in 2029 or 2030, our next bull run concludes. So let's say 3 years from now or so. Guess where your target is? Right up here. In 2030, what's your target? 10,000. Right there, guys. See that? Okay. Now, anywhere, depending on how, so basically the idea is we come back to about 3,500, right? And that's that level in there. Then, who knows how it goes? There you go. 10,000 on the logarithmic chart.
Gold is regaining strength after falling from $5,000, and overall, the trend still looks positive. Right now, gold seems to be pausing before moving higher, not reversing. Many expect gold to reach $10,000 by 2029 or 2030 because of inflation and steady demand. Jim Rickards, a macro strategist focused on currency systems, and Gareth Soloway, known for chart-based forecasting, indicate that gold's trajectory is supported by strong structural factors. Central bank accumulation continues to rise while supply remains relatively flat, tightening the long-term balance. From a technical perspective, even a retracement toward the $3,500 region would fit within a healthy bullish pattern before the next advance. The logarithmic trend suggests a gradual but powerful climb, with higher highs forming over time. As inflation persists and monetary expansion continues, gold may move in stages toward significantly higher levels. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
There are troubles and difficulties and stresses in the global monetary system, but de-dollarization is not one of them. And I'll give you a very simple example. What is the euro US dollar exchange rate, EUR/USD? What's the euro US dollar exchange rate right now? It is true that central banks are buying more gold. You're absolutely right about that. And I think you framed it exactly right. The contest is the dollar and gold. It's not the dollar right now. The euro is about $1.16. You know what the euro was when it was launched in 2000? It was $1.16. In other words, 25 years later, the euro-dollar exchange rate is exactly where it is. Now, it's bounced around. It was up to $1.60. It was down to 80 cents. It was like a great time to vacation in Europe. I understand that there's volatility. You can make or lose money trading. It's right where it was 25 years ago. There's no de-dollarization in the currency. Gold is different, and I agree with you completely. But what's going on with the dollar is not de-dollarization, except central banks are buying more gold. When central banks are selling treasuries, which they are, there's the Treasury has a monthly report on international currency holdings. It's a spreadsheet and it shows all the countries and how much they own in treasuries. Countries are selling treasuries, but they're not dumping them to get out of them. They wish they had more. They're selling them because they need dollars. Again, a security is not a currency. It's denominated in a currency. A U.S. Treasury security is denominated in dollars, but it's not a dollar. If you need dollars, you got to sell the Treasury, get the dollars. What are they doing with the dollars? They're propping up their own currencies, and they're propping up their banks. And they're dealing with credit crises, whether it's real estate in China or a private credit in the United States. So there's actually a global dollar shortage and the beginnings of a global dollar liquidity crisis. And the reason people are selling treasuries is not because they hate treasuries. It's because they need the dollars to prop up their banking system and pay off bad debts. And by the way, gold is having a nice bounce back. It's kind of rallying here. You're right about that. But it kind of got smashed from around 5,400 down to 4,700 in a matter of a week or so. What was that all about? Again, that wasn't I hate gold. That was people sold gold because they needed cash. And this is symptomatic of this liquidity crisis. So we're not looking at de-dollarization versus other currencies. We are looking at increases in gold. You're absolutely right about that. But the bigger play is there's a global dollar shortage. We may be walking into a buzzsaw in terms of a global liquidity crisis. And by the way, Michelle, that has been happening for a while. That's been playing out for a couple of years. $10,000 is still a realistic estimate. I said some time ago it was five. It got to five. It got smashed down a little bit. It's kind of working its way back to 5,000 in stages. But yeah, it'll go along with the kind of inflation that we talked about, The things we talked about earlier in the segment, Michelle, central bank demand is not going away. Supply is flat. Central bank demand is going up. The safe haven asset attractiveness of it is going up. To the extent people do want to, I sort of poured cold water on the de-dollarization thesis, but the idea that central banks are moving from dollars to gold, that's true. That's very well documented. So that will continue to drive it. And then I did the very simple bit of math where I pointed out that if you use $1,000 increment as a marker, each $1,000 increment is easier than the one before because you're working off a higher base, so it's a smaller percentage gain. So going from $4,000 to $5,000 an ounce is a 25% increase. That's a heavy lift. But going from $9,000 to $10,000 is only an 11% increase. That's much easier. So you kind of struggle. I don't know if it's the right word. You kind of struggle, or it'll take time to get to 6 or 7, but you're going to go 8, 9, 10 really quickly. I see problems in the global monetary system with or without the conflict. So I'm not sanguine about it. I think there's a lot of trouble in the global monetary system. The private credit meltdown, central banks going to gold instead of dollars, a global dollar shortage because the banks are pulling in their horns. All of those are problems. The Iran war is kind of an overlay on that. So I think it makes it worse. I would say we have a global monetary problem anyway, but the war makes it worse because of the increase, not just the increase in the price of oil, but the supply. The U.S. is not going to run out of oil. We got plenty, but the rest of the world, South Korea, Japan, China, others, they're going to see supply shortages. They already are. The dollar will remain the leading currency denomination. Again, it's the denomination that people like don't have $100. Yeah. Well, the unit of exchange is not the reserve currency. People don't have stacks of dollars in the basement of the central bank. What they have are treasury security. And no, I don't see that being rejected, but they are selling treasuries to get cash, which is a different. But gold is going up. I mean, the price of gold is going up, and the percentage of global reserves in gold is going up. It's what saved Russia during the Ukraine war. We froze, 300 billion of their treasury securities, but Vera Nabiullina, who's the head of the central bank of Russia, had put 25% of the reserves in physical gold. We couldn't freeze that. And in fact, when the price of gold started going up from $2,000 to $5,000 an ounce, Russia made as much mark to market on the price of gold as they lost on the frozen treasury. So that was a pretty smart move by her. And part of the reason it's happening now, and here's what I think a lot of people don't understand in terms of the Strait of Hormuz. The Strait of Hormuz was closed almost the day the war began. I think it was February 22nd. I mean, check me on the exact day, but it was around the end of February. But there was a lot of oil and natural gas and fertilizer, for that matter, in transit that was already outside the Straits of Hormuz. It was unaffected by the closure of the Strait of Hormuz. Now, that can take 2 or 3 weeks to get to South Korea and Japan and India and the ultimate users, and perhaps even longer, as I say in the case of South Korea. So the ships were underway; they were still delivering. The stockpiles were still there. There was nothing about closing the Straits of Hormuz that affected the supply immediately because it was already on the way. But now we're 7 weeks into. Now the supply has dried up. There are no tankers underway, and it's really just now, as we speak, that the shortage is going to kick in. So, are the Straits of Hormuz opened? Well, 10 hours ago, yes. Today, right now, no. Who knows about tomorrow? Maybe a few tankers are getting through. But the bigger point is that the pipeline of oil, natural gas, and fertilizer, helium in transit, that has dried up because those vessels have delivered, and now is when the danger really kicks in. Not to mention the infrastructure damage. Even if you had peace, love, and understanding in the Persian Gulf tomorrow, I don't expect that, by the way, but even if you did, the damage to Qatar's liquid natural gas facilities is extensive. That's going to take months, perhaps even longer, to repair. So this economic damage is there, with or without a ceasefire, and the ceasefire itself is incredibly shaky.
Gold is moving through a volatile consolidation phase, but the broader trajectory remains firmly upward as structural pressures build in the global monetary system. Despite sharp pullbacks from around $5,400 to $4,700, the market is stabilizing and gradually recovering, reflecting strong underlying demand. Central bank accumulation continues to rise while supply remains relatively flat, creating a long-term imbalance that supports higher prices. The main reason is that global money is tight, so people are forced to sell gold and treasuries. This situation makes gold even more important as a safe place to keep value, not just for trading. Gold may take a while to reach $6,000 or $7,000, but if it hits $9,000, climbing to $10,000 could go much faster. As money troubles grow and demand stays strong, gold could keep rising for years. Let's get back to the interview.
A lot of people ask me when I use logarithmic charts. I use logarithmic charts, number one, after I've looked at the linear chart, the normal chart. I always look at the linear chart first. And then when I'm going back really long, like literally in this case, back to the 1980 high pivot, which is 45 years ago, I'm going to go to the logarithmic chart to just see what mysteries can I unfold here. Because every little bit of nuanced information may give me an advantage. Now, if we look at this chart and we start to say, wow, all right, so let's just start connecting some lines here. What if we were to bring a trend line here and we do a parallel from that low, and we drag it up, look at what happens. I mean, this is amazing, folks. So literally when I was getting bearish on gold because it was going parabolic and so many people were bullish, look at what you have. You have your low pivot to your low pivot here, right through this low. You bring it to your high here in 1979, 1980, and we literally have a hit up here. Now remember, I've used this same sort of parallel. If we flip over to the regular chart of the S&P, what have I used it? I've used it to predict this recent down move in the S&P, and you can see it right here, right? Low pivot to this point here. So these lows, we connect them, and the parallel line goes to the bull market of 2021, the bear market here, and the bull market up here. I mean, remarkable. All right. You can also see this in other charts as well. Trend lines going back this far, for instance, not a parallel necessarily, but if you go to Bitcoin, this told me Bitcoin was topping in 2025 as well. The high pivot from the bull market of 2017 to the high pivot here in 2021. And look, when everyone else was bullish last year, this told me Bitcoin was topping. So these type of things are unbelievably important. Now let's flip back to the logarithmic chart, and it goes and gives us this beautiful, let's go back to the monthly chart, this beautiful parallel here. Now the other thing that's interesting that also told me there was, listen, one factor is fantastic, especially when it's a long-term parallel like this, but two factors are even better. All right, now right now we're talking about how I was able to talk about the top. Then we'll go into projection. So here, look at this as well, okay? You basically have this low connected right through that high, cuts right here. You had the blow off top reversal right here, and we get up right here. So this really, again, did I know exactly where gold was going to top? Was it going to be 5,600 Pierce? You could have gone a little higher, but the point is, look at how close those lines were. Major logarithmic trend lines connecting through here. And that, again, was telling us that while everyone was emotionally triggered to think that gold was going to go up forever and it was going to go to 10,000 in a year, whatever, it was the chart was saying, no. It's not that easy. And also, it became a speculative asset, and that's never a good thing for gold. All right, now, let's talk about upside potential. So using that same format, what if we, again, let's talk about parallels. So number one, we connect this low here, right? And that was kind of what we had done already, right? So that gives us that first top. But what if we connect this low through these lows and we use that same sort of format? So look at how these align perfectly on the logarithmic chart, okay? So here's a trend line. We take the low from 2001, basically 25 years ago. We connect it, and look at how on the logarithmic chart, it matches perfectly with the low of 2018, the low here in 2022, and the low in 2023. Now, what if we extend that parallel up? Well, first of all, look at this. So, this is, by the way, this is the stuff that freaking excites me so ridiculously. But look at this here. Look at right here. So what you're doing is you're looking to see, does the logarithmic and the new trend line have teeth? In other words, does it make sense? And look at that. Look at how it behaves as support, and support, then resistance, breakout. Now, what did I just tell you guys about my downside target in the near term on gold? Where did I say it was going to, my thesis is going to go? And you should all know 3,500, right? No hiding there. All right, so if we look at this, we can see, where is this trend line? If it were to retrace right there, look at that. What's that at? 3,500 right there. So that number one means that not only is that major technical support from here, but it also has a secondary factor there. Now, let's use this and extrapolate out. What if in the next bull cycle, we go up to this high here, okay? So the bull market high on the logarithmic chart from 2011. By the way, I'm not going to have time to do silver today. Taking, this is too much to go into, but that's okay. I'll do silver individually just like this in another video. But now, let's just say in 2029 or 2030, our next bull run concludes. So let's say 3 years from now or so, guess where your target is? Right up here. In 2030, what's your target? 10,000. Right there, guys. See that? Okay. Now, anywhere, depending on how, so basically the idea is we come back to about 3,500, right? And that's that level in there. Then, who knows how it goes, but there you go. 10,000 on the logarithmic chart. Pretty incredible stuff, isn't it? I love this stuff, guys. This is why I love charts, is because you can discover, it's like a mystery and you're unraveling it and you're discovering new discoveries that, listen, people like escape rooms, they're cool. People like mystery novels, they're cool. But in this, I get to potentially make millions of dollars off a discovery, or thousands or hundreds of thousands, whatever it may be. That's truly exciting.
Gold is entering an important stage in which both long and short-term trends are starting to align. After a sharp price rise, gold is now taking a break and might drop to about $3,500 before moving back up. This kind of pullback is common in past gold markets and can help set up bigger gains. What stands out is that broader long-term analysis suggests the current cycle is not yet finished. If the pattern continues, the next big move could take prices much higher by the end of the decade. The path may not be smooth, as ups and downs are expected, but the overall direction is upward. This means gold is in the middle phase, so patience is needed as the market prepares for the next growth phase. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Thanks for watching.